We've got a $60 gain. Where does that go? Well, that goes on our cash flow or our cash T account, and we credit the gain. As you can see, we credited the gain. We credited the gain here for 60 bucks, and that's exactly what we did here. We credited the gain. So we've already accounted for it, so we can ignore it. And then this other equipment, this note payable, we'll look at it once we get to the note payable. So our equipment T account balance is out. Now let's look at accumulated depreciation. We began with 510, subtracted 360. That does not equal 300. That actually equals, let's see, 510 minus 360. That equals 150. We need to end our accumulated depreciation at 300. So we need some kind of credit for 150 bucks in order to balance this this T account out. What kind of journal entry do we do when we credit accumulated depreciation? Well, we would have, and I'll do it on the side, we would have credited accumulated depreciation by 150 and debited depreciation expense by 150. So there's our credit for accumulated depreciation. We put it in the T account. This balances out. That's all good. We've also got a debit for depreciation expense for 150. Where does that go? Well, that goes into our cash T account as depreciation expense. We were going to debit depreciation expense by 150. We've already done it. So you can cross that off. This last step that I did with this accumulated depreciation is not necessary because hopefully you have already done this depreciation expense. But you know, if you have time on the exam, maybe it's a good check to make sure that you have all your depreciation accounted for. Anyway, let's get back to the balance sheet. So we've done accounts receivable, inventory, equipment, and accumulated depreciation. So we've done all the assets, which is cool. We're pretty much halfway done. Next is accounts payable. So again, making an accounts payable T account. We began with 4,000 and ended with 5,000. Accounts payable is a liability, so it has a natural credit. Began with 4,000, ended with 5,000. Therefore, we increased accounts payable by 1,000 bucks. If we're crediting accounts payable by 1,000 bucks, that means we're going to debit cash by 1,000 bucks. And in which section? Accounts payable is a current liability, so it's going to go in the operating section for 1,000 bucks. There we go. So we got accounts payable done. We've got unearned sales revenue, which hopefully you remember that's a liability. It's kind of a strange liability. Unearned service revenue, we owe someone some kind of service or some kind of product that we haven't given them yet. They've paid for it, but we haven't given them whatever they paid for. So it's a liability. Set up the T account, unearned revenue. We began with 6,000, ended with 3,000. Again, it's a liability, so it's a credit. Therefore, during the year, we debited unearned revenue by 3,000. A debit to unearned revenue is a credit to cash. So go back to our cash T account. We're going to credit cash, and in which section? Well, unearned service revenue is a current asset. So credit cash for $3,000 for unearned service revenue or unearned revenue. There we go. All right, next one, we've got a note payable for $1,000. All right, set up the T account for that. Note payable. We began with 0 and we ended with 1,000. There's our T account. Now, if you remember, we did some kind of journal entry with note payable, so we'll look back at this. Note payable. Credited it for $1,000. There we go. Can mark that off because we did it. And there was nothing else related to notes payable. So this note payable, we're crediting notes payable for $1,000. That does not mean we're going to debit cash for $1,000, because if you look back at the journal entry, what happened here? Well, we debited equipment and we credited notes payable. Nowhere in this journal entry did cash be affected. So the cash flow statement, we don't do anything with the cash flow statement. What we actually do is we make a little footnote at the very bottom and we say something like purchased equipment for $1,000 with a note payable, something like that. Cash is not affected, but since it's a non-cash purchase, we're going to make a little footnote on the bottom to explain why equipment increased by $1,000 and why notes payable increased by $1,000 to our investors. So that's it with notes payable. Coming up next is the bond payable. The bond payable, we started just like the note payable with 0, ended with 1,000. Bond payable T account, start with 0, ended with 1,000. And if you remember back to our journal entries, there was an entry for bond payable. We are increasing the bond payable, or crediting the bond payable by 1,000. There's our T account, it balances out. No other journal entries affect bonds payable, so we're good. But there's a debit to cash, so therefore we're going to debit our cash flow by $1,000. In which section? Well, bonds payable is a long-term liability, so we're going to debit cash flow by $1,000. And you would say something like we issued a bond payable. We can cross that off because we have accounted for it, and there we go. So up next is common stock at par. Again, we'll do the journal entry for that. So we've got common stock at par. We started at 2,000, ended at 3,000 as a credit. And if you look back at our journal entry, you can see we credited common stock by 1,000. Our T account balances, we can cross this off. There's no other common stock being affected. We've done all these journal entries. And then we'll do our additional paid in capital. Additional paid in capital. We started with 1,000 as a credit, ended with 1,750 as a credit. And you can see in our journal entry we credited additional paid-in capital by $750. Our T account balances, we have nothing else to do with paid-in capital. We can see that we increased cash or debited cash by $1750, so we'll affect our cash T account by $1750. Which section? Well, common stock is an equity account, so we will debit cash by $1750 for issuing common stock. There we go. So now we can cross this guy off. And finally, I believe, our retained earnings. We began with $27.90, ended with $250. Retained earnings. Again, it's an equity section, so we'll just keep it as a credit. There we go. So here's our beginning retained earnings, ending retained earnings. Now, if you remember the equation, we've got our beginning retained earnings plus net income minus dividends equals ending. There's our equation. So beginning, ending, we're going to add our net income, subtract our dividends. So our net income is $19.10. If you look at the income statement, it's still there. And we paid a dividend of $44.50, which is in the supplemental information. If that's not given to you, you can just figure it out using this T account. But at any rate, so this plus this minus our dividends equals our ending retained earnings. Our T account balances out, so we're feeling good. We can also look at our journal entry, what we did here. We debited our dividends, like we did here. Debit dividends for $44.50. We debit our dividends and retained earnings for $44.50, so we can cross that off. We've also credited cash for $44.50, so that's going to affect our cash flow or our cash T account. We're going to credit cash for $44.50. In which section? Well, it's an equity account. Dividends is in equity. So we'll credit cash $44.50 for dividends paid. And there we go. So we can cross that off to finally put the nail in the coffin and to end this mess. So there we go. We should have all our information in this cash flow, whatever. Next thing to do is to figure out our cash flow from operations, cash flow from investing, cash flow from financing. And the way to do that is you add up all your debits, subtract your credits, and our cash flow from operations should be $400. Our cash flow from investing is our debits minus our credits, which is $300. And then our cash flow from financing is our debits minus our credits, which is negative $1,700. So you can put it as negative $1,700, or you can just put it as a credit over there. So there's our amounts. 400 plus 300 minus 1,700 is a grand total of change in cash. Oh, can't spell. Change in cash is going to be negative 1,000, looks like. And again, you just take 400 plus 3 minus 1,700. There's our change in cash. And as a final check, we look at our beginning cash. Our beginning cash looks like it was 8,000. Therefore, our ending cash should be 7,000. And if you look back at our balance sheet, That is exactly what it says. And we know we're right. There we go. Now, I know there are different ways of, like, different steps of how you approach this problem, and hopefully I did it very similar to how the TAs did it. I think what they did is they automatically did the supplemental information, wrote the journal entries, and maybe they even went to the T accounts right away. I do it a slightly different way, even a different way than what I just did now. But as long as you do all the steps, and as long as everything kind of proceeds in or you're able to keep track of everything that you've done, as long as you've done everything, you'll get it right. So it doesn't matter what order it is, as long as you do it all. Okay, to finish this off,